Hello everyone. In today's video we are going to be talking all about derivatives. Now I know this term sounds complicated to a lot of people, especially ones who are not familiar with the terminology or have not dealt in derivatives in the past, but we are going to try and break it down to the simplest way possible. So what is a derivative? In essence, a derivative is a financial contract that derives its value from an underlying asset. It does not have a value of its own and the price of it comes from some underlying asset. Now what could be such an example? Well, it could be currency, commodity, an interest rate bearing instrument. It could be an index or a stock. Any of these could be the asset based on which a derivative contract is made. In essence, what we are doing is betting on the future movement of price of this asset. So either we could bet that the price is going to go up, which is a bullish view, the price going down, which is a bearish view, or we could also bet that the price is going to remain sideways. Derivatives are used broadly by three categories of traders. Either they are arbitrageurs, they could be hedgers, or as is the majority case, they could be speculators. And the speculator is betting that the price is going to move in a certain direction and wanting to profit from it. What are the types of contracts in this? Swaps is one of the contract which is not really very common, so we are not going to be talking about it. Most of the retail, HNI, individual investors invest either through futures or through options. So these are the two that we are going to explain today. Futures, well, it is nothing but a leverage trade of a price movement of a particular asset. Let's explain this with an example. Let's say today Nifty 50 is around 25,000 level and we expect that 1 month down the line it's going to be at say 27,000. We are expecting broadly a 10% up move in the value of the Nifty. And basis this we buy a futures contract, expecting that the price of it is going to go up over the next 1 month. If our view comes true, then we don't make just the 10% return that the market itself has moved. We end up actually making much more on our initial investment. And the reason for that being, it's a highly leveraged trade. In the same way, the person who has sold this particular futures would have made a loss on it. And it is the duty of intermediaries such as the exchange, the clearing corporation, banks, etc. to ensure that each of the party honors their commitment. And that is what futures is all about. And now we come to options. In an option, it is slightly different because in an option, the buyer of the option has the right but not the obligation to fulfill the contract. Whereas the seller of the option, he must fulfill the contract if the buyer wants him to. Again, within this, there are two types of options, a call option or a put option. A call option gives the buyer of the option the right to purchase the particular asset at a prefixed price. And in case of a put option, the buyer of the option has a right to sell the asset at a prefixed price. I know it could be sounding a bit complicated. We will try and simplify this with an example. Let's take the example of crude oil. We have a barrel of crude oil selling at $100 a barrel and we expect the price of it to go up. We feel that maybe a month down the line it will be $105. So we can buy a futures contract, buy an options contract, call option at say a price of 101. Right? So we feel that if the price goes to 105, we exercise this option, we buy it from the other seller at 101 and then in the open market we can in turn sell it at 105 and make a clean profit of 4 rupees. On the other hand, if we expect that the value of it is going to go down, then what do? We buy a put option. We say that a put option of 99 rupees. Expecting that tomorrow if the value of crude oil falls to 96, we can still sell it to 99 because we have the option to exercise this, our put option. We can still sell it at 99 and buy from the open market at 96, selling it at 99 and making a profit of 3 rupees. In a very simplistic way, this is how futures and options work. Having said that, options do have a lot of strategies within it. So there are covered calls and puts, there are spreads that can be made, debit spreads as well as credit spreads. There are butterflies, condors, there are numerous number of strategies that can be built around options. And these need to be understood in detail. In a very, if I have to put it very simplistically, what I can say is, if you are not aware of how to use futures and options, please stay away from this tool. They are not the simplest instruments to understand. There are far easier ways also of making money in the market. But people have this big tendency to get into futures and options, and unless you really understand the integrities and working of it, I would say that it's an instrument that is best avoided for most of the retail and HNI investors. You really want to learn about it, then there are courses to be done, there is in-depth knowledge available, and only after that probably you should look at getting into some of these trades. So that is our opinion from Aurivox. Well, we at Aurivox, we don't really advise people to get much into derivatives trade. This was more of an educational masterclass. And to know more about what we do and the kind of systems we have and how we benefit investors, you could visit our website www.aurivoxfinancial.com. We are going to be coming up with more such classes in the future, so stay tuned for further updates. Thank you so much for watching, and we hope to see you in the next one.